R. So this is basically financial management. And I'm going to look at some questions from financial management last sitting. How is it that students came out of last sitting exam and I saw people crying all over? Was this paper really that tough? I doubt, or I digress from that kind of a thought. And I'll be able to show you that this paper, of course, even if it was tough, you guys are going to pass. But I mean, it should not have been a paper that should have made any student who was well prepared to sweat. No, it was a straightforward paper. And I will be able to tackle 2 questions right away here now. And then I'll be able to give you secrets that you need to be able to become now good in terms of even advanced financial management. Because this one, even if it was a tough paper, I'm 100% sure that you will pass. Even if it was a tough paper, I'm 100% sure that you will pass. All right. Great. So then I start with August 2025, question number 4. August 2025, question number 4. So August 2025, question number 4B. Question number 4B. Question number 4B. I read the question. It is here. I read the question. So you're told, Mara Limited is a company quoted at the Securities Exchange and is experiencing a period of rapid growth. Due to this, a momentous growth of 15% per annum is anticipated during the next 5 years. Thereafter, a normal growth rate of 5% per annum is expected indefinitely. The shareholders of the company requires a rate of return of 10% per annum on their investments. During the previous year, the company paid a 4 per share as dividends. Now, ladies and gentlemen, if I got this kind of a question, then what will I do? First of all, the examiner has guided me. He's telling me that during the last year, the dividend that was paid is 4. So our existing dividend that we know of as at today, what we call D0, in this case here is 4. So this is what was paid by the end of last year. It is our existing dividend. So this is what we call our today's dividend. Our dividend at time 0 is 4. Then they are telling us that for the next 5 years, they expect this dividend to grow by 15%. So then because I want future dividends, yeah, not historical dividends, I will come here and make time, and then now I have my dividends here. Yeah, so time from time 1. Remember, to value a share, to value a business, we look at the future cash flows that we shall receive. We don't look at what has already been paid. What has been paid is X, is past. So the DO is past. I can't use the past to value my future. Yeah, so in this case here, we start from time 1, henceforth. So we have here time 1, time 2, time 3, time 4, time 5, and then you have heard of what year? You have heard of infinity. You have heard of infinity. So then we have been told that for the next 5 years, each year, we expect this existing dividend to grow by 15%. So it means that here it will be 4 times 1 plus R. R is 15%. So it will be 4 times 1.15. Can somebody give me this answer? 4 times 1.15. I want to know the dividend payable at the end of year 1. dividend payable at the end of year 1. Please help me out because I don't have a calculator. I will really be dependent on what you guys give me. I will be depending on what you guys give me. So I'm being told that this is 4.6 by Jane. Thank you so much. So I'm being told that this is 4.6. Then we go to year number 2. So year number 2, it will be 4.6 times this 1.15. It will be 4. So I'll take this figure, let it grow by another year. Yeah. So please give me like 3 decimal places. Give me like 3 decimal places, and then I'll be able to give you a secret. What you need to do to be able to pass this paper on the very first round. On the very first round. I don't want us to go round 2. I don't want us to go round 2. RCM students shall always pass these papers 1 term, not 2 term. Not 2 terms, but 1 term. 1 term. So I'm waiting for you to give me this answer. Yeah, 4.6 times 1.15. So Emily is giving me 5.29. Thank you so much. So then it's 2 decimal places, no problem. So 5.29. And you see, the same figure, you would have also gotten the same figure raised to power 2 because of year 2. Times, I prefer just having this figure, we grow it by 1 more year like that. So 5.29 times 1.15. Yeah. So please help me out. 5.29 times 1.15. Remember, every year for the next 5 years, we are going to have our growth rate being 15% per annum. Being 15% per annum. Being 15% per annum. So according to Mary Massey, it is 6.08. Let me just 2 decimal places to be consistent. So we come here, this is 6.08 times 1.15. Let's strictly work with 2 decimal places. We shall work with 2 decimal places strictly for purpose of learning. Yeah, and I hope everybody is trying to help Mwalimu answers. 6.08 times 1.15. This one here will give me 6.99. 6.99. So then come to year number 5. Year number 5 will be 6.99 times the 1.15 is going to be constant. 1.15 is going to be constant. 1.15 is going to be constant throughout. 1.15 is going to be constant throughout. 1.15 is going to be constant throughout. So in this case here, according to Massey, it is 8.0. It is 8.04. Thank you so much. It is 8.04 like that. Now, ladies and gentlemen, what happens in this case here after year number 5? So after year number 5, we are told here, for the next 5 years, thereafter, a normal growth rate of 5% per annum is expected indefinitely, in perpetuity, in perpetuity. So in this case here, we need a perpetual cash flow. We need a perpetual cash flow because we have a growth rate of 5% per annum, and the N in this case here now is infinity, what we call perpetuity. Whenever we talk of perpetuity, we shall always perpetuity, we shall always remember what we call the Gachagua model. I normally call it the Gachagua model. I normally call it the Gachagua model. Very, very important. Ladies and gentlemen, if you ask, of course, I'm not a politician, but if you ask any people who are in the leading party, the leaders in Kenya here, I want to believe that they did a mistake impeaching Gachagua. Truth be said, lucky is, making these people to sweat. So anytime you hear of perpetuity, remember that Gachagua was supposed to be in government, regardless of how quote unquote bad he is. That they should have left him. So anytime you hear about indefinite, always remember Gachagwa's model. So this Gachagwa's model, how does it look like? Very important. It's a joke, but it has helped so many people to pass this paper. So you normally say PO, according to Gachagwa's model, equals district officer. Remember, Gachagua was a district officer. Gachagua was a district officer. So anytime we talk about Gachagua, always remember the concept of present value, PO, equals district officer into 1 plus growth rate all over Kenya without government, all over Kenya without government. I'm so sure somebody may feel bad that Mwalimu, perhaps you're trying to say bad about the president, or perhaps you're saying something bad about Gachagua. No, I'm just trying to spice up my teaching in a way that you shall never forget this indefinite model. Yeah, the guy could be out of government, but he will be relevant for many years to come, given that he's an orator. Whenever you are an orator, ladies and gentlemen, people cannot just wish you away anyhow. Just like our president, of course, he's an orator. He's a good public speaker. Whenever you're a good public speaker, you are able to, in this case here, create a narrative. You're able to create a narrative. So whenever you hear about indefinite cash flows, indefinite growth, always remember about Gachagwa's model. So what is this DO? Now I want to get the perpetuity cash flow, because you see the perpetuity cash flow will never be given to you. The perpetuity cash flow will never be given to you. To get this perpetuity cash flow, this is what we shall do. So remember, this is a current price. Whenever you see O, it means current. This is current dividend, current dividend. This is cost of equity. KE stands for cost of equity. Cost of equity. Cost of equity. We have G standing for growth rate. G stands for growth rate. We have DO standing for the current dividend per share. Current dividend per share. Now, ladies and gentlemen, the DO that I will use here is not this one. Remember, now we have been able to forecast ahead. The most current dividend that I'll be able to use to get this is this 8.04. Look at what I will be doing. To be able to get this perpetual cash flow, I will take 8.04. This is the most current dividend. Then I say 1 plus the perpetual growth rate. They have told us after year 5, these dividends will be growing at 5% indefinitely. So in this case here, the G here, after 5 years, it will be 0.05. We put this into brackets, ladies and gentlemen, all over. Has this examiner given me the cost of equity? Has this examiner given me the cost of equity? At times they could just call it the cost of capital, but because you are valuing a share, it should be cost of equity. So has this examiner given me the cost of equity? Has this examiner given me the cost of equity? Yeah, so you can see here, the cost of equity is the shareholders' return. The shareholders' return. The shareholders of the company require a rate of return of 10%. So 10% is the same as 0.1. 10% is the same as 0.1. So the cost of equity is 0.1 minus this perpetual growth rate, which is 0.05. So then I want you to do me a favor. Please do this separately. Go ahead and tell me what is 8.04 times 1.05. Just give me the numerator answer. Please give me the numerator answer alone. Numerator answer alone. You are taking 8.04 times 1.05. What are we able to get here? Just give me the numerator alone. The numerator answer alone. The numerator answer alone. What do we have there? The numerator answer alone. What do we have here? I know the denominator. I know the denominator. I have here for the denominator. I know the denominator is 0.05. But how about the numerator? Because this minus this is 0.05. Yeah. So in this case here, we have Mercy giving me 8.44. Thank you so much. 8.44. So then is there somebody who is able to give me now this quotient? Anybody who is able to give me this quotient? What do we have there? Anybody who is able to give me this quotient? What do we have there? Quotient means that we are dividing. So 8.44 divided by 0.05. What do we have there? 8.44 divided by 0.05. What do we have there? So according to Mercy, we have 168. 0.8. Once you know how to compute these perpetual growth rates, you will never go wrong. They are called perpetual growth rates, the Gachagua model. You will never go wrong. Now, ladies and gentlemen, remember what we normally do in terms of share valuation. Once you have been able to give us that these are the expected dividends, to be able to get share value, take those dividends, they are futuristic, now discount them. So come here and they give us what we call present value interest factor, because these are different. You can see, give me present value interest factor. Now, ladies and gentlemen, for me to be able to get this PVIF, this PVIF, present value interest factor, this is what I will do. To be able to get this PVIF, we shall take 1 plus R raised to negative n, if you remember the formula. So PVIF is present value interest factor. PVIF is present value interest factor. To get this PVIF, we take 1 plus R raised to negative n. What is this R? R is the required return. The required return. In this case here, we are doing share valuation. Whenever we're doing share valuation, the required return will be the return to the shareholders, The return to the shareholders, they have told us is 10%. So then this one here will be 1.1 raised to negative n. So it will be, so it will be 1.1 raised to negative 1, because n is time. So this one here will be 1.1 raised to negative 2, 1.1 raised to negative 3, 1.1 raised to negative 4, 1.1 raised to negative 5. So first of all, give me these figures, which either before you look at these computations, you can also decide to read those figures from your tables. So is there somebody who can give me these answers? Now remember PVIF, present value interest factor, you must give this to me in 2 decimal places. So what do we have, my good students here? PVIF. Where did I get 1.1 from? Remember, our R is 10%. Our required return is 10%, which is the same as 0.1. Therefore, 1 plus R is the same as 1 plus 0.1, which will end up giving us 1.1. Yeah, so remember PVIF, ladies and gentlemen, present value interest factors, the discount factors must always be rounded off to 4 decimal places, always. You can round other numbers into 2 decimal places, but PVIF must always be in terms of 4 decimal places. So what do we have there, my good students? I think it should be something like 0.9091. 0.9091, the first one. Yeah, because there must be 4 decimal places. Is there somebody who is able to see the 0.9091? Please help me, because I'm almost finishing. How about 1.1 raised to minus 2? Help me. Please help me. I would want to finish. And those students who haven't yet joined RCM College, you don't know what you're missing. RCM College is the premier college. Whenever it comes to CPA training, CIFA training, there is no college which can, in this case here, rival with us. We are way ahead. That's our number. So 0.8264. So 0.8264, yeah. 0.8264, yeah. Then 1.1 raised to minus 3. 1.1 raised to minus 3 will end up giving us a what figure? 1.1 raised to minus 3 will end up giving us 0.7513. 0.7513. And then we have 1.1 raised to minus 4. 1.1 raised to minus 4. 1.1 raised to minus 4, that will end up giving us a what figure? According to 𝒐𝒏, it is 0.68. 0.6813. 0.6830. And then now we have the very last one, which is 1.5 raised to negative 5. So I know you know how to raise. 1.1 raised to negative 5. 1.1 raised to negative 5. I'm being given by 𝒐𝒏 there, 0.6209. 0.6209. Now listen and listen to me very well. You see now for the infinity, this infinity, we have been able to discount perpetually from up there to this not beginning, but end of year 5. Because infinity begins from end of year 5. So this has already been discounted there using that infinite, but it has come to the end of year 5. Better put, we got this figure by using the figure of year 5. So it means that for discounting, you can't say 1.1 raised to negative infinity. No. For discounting purposes, in this case, whatever figure you have here is what you drop down there. So here we repeat the same figure. We repeat the same figure down there. So then your role this afternoon is to come and give me the discounted cash flows. Your role is to come and give me the discounted cash flows. So how do we get the discounted cash flows? Remember, these future dividends is the cash I expect. These are the cash flows. So basically, you take these cash flows times this as the discounting factors to be able to give us the discounted cash flows. So you take, like, the first one is 4.6 times this 0.9091. Discounted cash flows, I don't have a problem. You can round those up to 2 decimal places. You can round those up to 2 decimal places, and then you give me an answer. I don't have a problem with discounted cash flows. Having them in 2 decimal places, that is sufficient. That suffices. That suffices. So discounted cash flows. So we have here 4.6 times 0.9091. What answer do we have here, ladies and gentlemen? What answer do we have here, ladies and gentlemen? So we have here 4.18. 4.18. Then we have 5.29. 5.29 times these. Please give me an answer. You're almost finishing. And I will always reiterate the fact that RCM College is the #1 college in terms of CPA classes, CPA solutions. We have solutions for you. If you are far away, like Chogio, Mandera, etc., we have online classes for you. If you are within Nairobi and you feel that you need to pop onto some physical class, you simply come to Commonwealth House. We are right opposite Galitos, this building along Moi Avenue, which has a Highlands restaurant. You come here all the way up to 5th floor. We have a solution for you. We have a solution for you. All right. So I'm being given a figure of 4.37. Thank you so much. Thank you so much. So I'm waiting for the third one. As I wait for the third one, if you want to join RCM College, which is accredited fully by CASNEB, and we're giving help loans, this is our number, 0793 555 000. As I wait for the third figure, our phone number is 0793 555 000. Yeah, so I'm being given 4.57. 4.57, the third one. So please, all of you, just give me the fourth figure. Please, all of you, please give me the fourth figure. All of you, kindly give me the fourth figure. Kindly give me the fourth figure. All of you, kindly give me the fourth figure. I can see the 7 sevens are very many. So I'm being given here 4.77, 4.77, 4.77, 4.77. And then we go to the fifth one. I'm happy because I'm getting figures from everybody, which means that really students over here, RCM students, are also the best. If you're an employer outside there looking for a very, very good high-grade accountant, give that space, give that opportunity to RCM students. Yeah, so I'm being given a figure of 4.99. Thank you so much. And then now we have the last one. The last one is 168.8 times this 0.6209. What figure are we getting there? 168.8 times 0.6209. What figure are we getting here? 168.8 times 0.6209. What figure are we getting here? The very last one. The very last one. And then we talk about something interesting. So I'm getting 104.81. So I'm getting here 104.81. 104.81. And therefore, come and give us the total discounted cash flows. Total discounted cash flows. This will be the value of the share. Value of the share. So the value of the share will be the sum over what I expect to receive. That is the maximum price of that share. I can't pay more than that because I'll always pay, knowing how much I will be receiving myself. So somebody should be able to go there and add up everything, and then they give me the total discounted cash flow, which will be the value of a share. So I'll take this as part 1 of our today's session. And then part 2, I will be doing another question from last semester. Yeah, so I'll be able to have 2 videos. I'll end this video immediately after this. And then, of course, part 2, especially the students who are following me on YouTube, please search for part 2 of this particular session. Yeah, you like this. And of course, as you search in between, now that I'm giving you great high quality content and ensure that you're giving me a subscription, I'll be very happy when I get your subscription. So what is the total, ladies and gentlemen? I can't see anybody giving me the total. Please give me the total. 127.69. Thank you so much. 127.69. Then this is the answer. So anybody who attempted this exam last semester, this question was low hanging. This question was low hanging for everybody. All right. So if you'll be able to hang around, I'll be able to do 1 extra question. So these students who are in this class, are you allowing Mwalimu to do another question? Are you allowing Mwalimu to do another question? 127.69. Thank you so much. Are you allowing Mwalimu to do another question? Or are you very tired? Or are you very... Thank you so much. So then I'll be able to end this. Let me just continue here. My aim is to do all the questions. And before I even end this semester, given how students are crying about financial management, management accounting, advanced financial management, advanced management accounting, we shall be offering special revision classes. From this semester, we shall be offering special revision classes. Those special revision classes will be for the students who attempted the papers and unfortunately they failed. Instead of them joining the normal students, then they should be able to join classes that I now teach myself, and we shall be able to see places. If you'll be interested in those kind of classes, of course, this will be our number, 0793 555 000.